The banks just smashed the paper price of silver to $61.96. They want you to believe the rally is over. They want you to believe that silver is just a speculative bubble that popped. They are lying to you. And this isn't just a little lie. This is a lie of omission so massive, it borders on criminal negligence. While you were staring at the COMEX ticker yesterday, while the algorithms were dumping paper contracts in New York, something happened in South Korea that makes the price of silver irrelevant. Something happened that changes the fundamental chemistry of the global energy transition. Samsung SDI, one of the largest battery manufacturers on the planet, just quietly confirmed the specifications for their new solid-state production line. The media is calling it a breakthrough. They are talking about 900-mile range and 9-minute charging. But they are missing the single most important detail. The detail that Wall Street hasn't priced in. The detail that makes a 1.1 billion ounce deficit look like a rounding error. The secret ingredient in Samsung's new battery isn't lithium. It isn't cobalt. It isn't nickel. It is silver. And not just a trace amount. We are talking about a massive structural increase in silver consumption per vehicle. We are talking about a technology that moves silver from being a precious metal to a strategic energy metal. In this 4-part deep dive, I'm going to expose the silver bomb that Samsung just dropped on the global supply chain. I'm going to walk you through the chemistry of the silver carbon anode. I'm going to do the math that the IEA refuses to publish. The math that proves there literally isn't enough silver on Earth to electrify the fleet using this technology. And I'm going to show you why Friday's price drop to $62 wasn't a crash. It was the last chance you will ever have to buy silver before the auto industry realizes they have made a fatal calculation. The banks are playing a paper game. Samsung is playing a physics game. Physics always wins. To understand why this news is an extinction-level event for silver supply, you have to understand a little bit of chemistry. Don't worry, I'll keep it simple. For 30 years, the world has run on lithium-ion batteries. Your phone, your laptop, the Tesla in your driveway, they all use liquid electrolytes. They are great, but they have a fatal flaw, the dendrite. When you charge a lithium battery too fast, the lithium ions form these little needle-like crystals called dendrites. They grow like jagged roots inside the battery. Eventually, they pierce the separator, the wall between the positive and negative side. When that happens, boom, short circuit, thermal runaway, fire. This is why EVs take 45 minutes to charge. You have to charge them slowly to stop the dendrites from growing. The industry has been chasing the holy grail, the solid-state battery. No liquid, no fire risk, instant charging. But every company from Toyota to Volkswagen failed for a decade. Why? Because they couldn't stop the dendrites from forming on the anode. Graphite didn't work. Silicon expanded too much. Pure lithium was unstable. Then, the researchers at Samsung SDI found the solution. They discovered that one specific element, when applied as a nanocomposite layer, completely solved the problem. It allowed the lithium ions to move freely, but it stopped the dendrites cold. That element is silver. Specifically, a silver carbon, AgC, nanocomposite layer. This isn't theory, this is published science. The silver acts as a host for the lithium ions. It dissolves them evenly, preventing the spikes from forming. But here is the massive catch. To make this battery work, you don't need micrograms of silver like in a circuit board. You need grams. For the first time in history, silver is not just a conductor. It is an active material in the battery's DNA. The auto industry is about to scale this to millions of cars. And the mining industry is asleep at the wheel. We are tracking this industrial pivot day by day. We are racing to hit 1,000 subscribers by December 31st, 2025. If we hit that number, I am going to release the killer video. The list of unhedged silver miners that are best positioned to survive this supply squeeze. I need 1,000 insiders to justify the risk. So hit subscribe. Now, let's run the math on what happens when 90 million cars need 50 grams of silver each. You might be thinking, okay, so they use a little silver. So what? Cars already use silver. Let's put this into context. Right now, a standard gas car uses about 15 to 20 grams of silver. It's in the window switches, the seat motors, and the defrosters. A current electric vehicle, like a Tesla, uses more, about 30 to 50 grams. This EV bump is already draining the market, and is part of the reason we have a 1.1 billion ounce deficit today. But the solid-state battery changes the math entirely. We aren't talking about switches anymore. We are talking about coating the entire anode of every single cell in a 1,000-pound battery pack. Early estimates from Samsung suggest the silver loading could be anywhere from 5 to 10 grams per kilogram of anode material. Let's be extremely conservative. Let's assume this technology adds just 50 grams of silver per car. That brings the total silver per EV to roughly 100 grams. There are 90 million cars produced globally every year. If just 10% of them switch to solid-state batteries, that is 9 million cars. 9 million cars times 100 grams equals 29 million ounces. That sounds manageable, right? But what if adoption hits 50%? What if Ford and GM switch their massive trucks to this tech? If the auto industry hits its targets for 2028, we could see automotive demand jump from 90 million ounces a year to 200 or 300 million ounces a year. Where does that extra 200 million ounces come from? Does it come from the COMEX? The COMEX only has roughly 30 million ounces left in registered inventory. Does it come from the miners? Global mining production is flat at 830 million ounces. This single technology, the silver carbon anode, has the potential to consume 25% to 35% of the entire global mine supply just for car batteries. That leaves 0 silver for solar panels, 0 silver for electronics, 0 silver for jewelry, and 0 silver for you. While the banks were smashing the price to $61.50 on Friday, Samsung procurement officers were likely locking in long-term supply contracts with miners. They know the math. They know that if they don't secure the silver now, their billion-dollar battery factories are worthless. This leads to a terrifying reality for the auto industry. They operate on razor-thin margins. If silver goes from $60 to $200 an ounce, the cost of the battery pack skyrockets and their profit evaporates. So, what will they do? They will try to thrift it out. They will tell their engineers to use less silver. They will try to use silver-coated carbon instead of pure silver powder. But here's the problem. Chemistry is stubborn. You cannot cheat the electron. If you reduce the amount of silver, the dendrites come back. If the dendrites come back, the car catches fire in someone's garage. Would you buy a car that had a 5% chance of exploding just to save $500? No. Samsung knows this. Toyota knows this. They cannot thrift the silver out without sacrificing safety. This makes the demand inelastic. They must buy it, regardless of the price. But what about recycling? The skeptics scream. Let's talk about the recycling myth. Gold is recycled at a rate of nearly 90% because it's concentrated in bars and jewelry. Silver is recycled at a rate of less than 20%. Why? Because of dispersion. Silver is the vampire dust of industry. It is sprinkled in microscopic amounts across billions of devices. There is 0.1 gram in your phone, 0.5 grams in your laptop, a thin film in a solar panel. It costs more energy and money to extract that silver than the silver is worth. So, it goes to the landfill. We are literally burying billions of ounces of silver back into the earth, but in a form that is impossible to mine. And the solid-state battery? Yes, it uses more silver. But do you recycle a car battery next year? No, you recycle it in 15 years. The silver that goes into a Samsung battery in 2026 is locked away until 2041. The recycling wave everyone is hoping for won't arrive in time to save us from the shortage of this decade. So, we have inelastic demand colliding with a supply chain that has been starved of capital. Friday's drop to $61.50 is laughable in this context. We are looking at a future where silver is as critical to the economy as oil. So, we have established the technology and the math. The shortage is structural. But how do you profit from this? Friday's drop to $61.50 scared the tourists, but for you, it is a gift. Here is the strategic playbook to front-run the auto industry. Lane 1 is physical metal. But, in an industrial squeeze, the rules change completely. For years, dealers have pushed semi-numismatics, collectible coins, limited editions, cool designs. In a normal market, those are fine. But we are entering an industrial vacuum. When Samsung needs silver for a battery, they do not care if it has a picture of Darth Vader on it. They do not care if it is graded MS-70. They care about one thing: the atom. They need raw silver to melt down into nanopowder. This means that in a true shortage, the premium on collectibles collapses relative to the spot price. The industrial buyer sets the floor. The strategy: stop paying for art. Start paying for weight. Buy the cheapest, most recognized government or corporate bullion you can find. 100-ounce bars, 10-ounce bars, generic rounds. Your goal is to accumulate the maximum number of grams before Samsung clears the shelf. Lane 2 is mining stocks. This is where life-changing wealth is made. But it is also where the hedging trap kills portfolios. Imagine a company called Loser Gold Corp. Last year, they were scared, so they signed a contract to sell 50% of their future production at $30 an ounce. Today, silver is $61.50. Loser Gold Corp is still selling for $30. The bank keeps the profit. Their stock won't move. Now imagine Winner Silver Inc. They refused to hedge. They sell every ounce at the spot price. If silver goes from $30 to $100, a 3 times move, their profit margin might go from $10 to $80, an 8 times move. This is called operating leverage, the strategy. You must audit the miners you own. Go to their quarterly reports. Look for the section labeled Hedging and Derivatives. If you see forward sales, run away. You want 100% unhedged exposure to the spot price. This brings us to a choice. Do you want safety or do you want maximum profit? I want to know your strategy. Are you stacking weight, physical bars, or are you chasing leverage, mining stocks? Go to the comments and type your answer. There is one final filter you must apply to your portfolio: geography. The US and EU have passed laws requiring battery materials to be sourced from friendly nations to qualify for tax credits. This creates a two-tier market: clean silver versus dirty silver. Samsung and Tesla will pay a premium for silver from Tier 1 jurisdictions: Canada, the USA, and Australia, because it keeps their supply chain legal and secure. In contrast, Latin America, Mexico, Peru, is facing a wave of resource nationalism. As silver hits $100, the temptation for these governments to seize mines or block exports becomes 100%. If your mining stock operates solely in a jurisdiction with a history of seizure, you are holding a ticking time bomb. Tilt your portfolio toward the safe zones. Finally, let's talk about the exit. I told you not to sell for fiat, but you must eventually rotate out of this trade. Technology moves fast. Right now, the silver carbon anode is the winner. It will drive the market for the next 7 to 10 years. But in 2035, maybe they invent a graphene anode that uses no silver. Commodity supercycles driven by tech usually last a decade. We are at year 0. You have a long runway. But stay vigilant. If you see headlines in 5 years saying Toyota invents silver-free battery, that is your signal to swap your stacks into land or other assets. Don't marry the trade forever. Marry the macro. Date the tech. We have arrived at the conclusion. It is Sunday night. The markets are about to open. The price has been frozen at $61.96 all weekend. But while New York slept, the information traveled. The engineers in Korea and the traders in Shanghai have crunched the numbers on the Samsung battery. Here is my prediction for the open. Watch the Shanghai arbitrage. Right now, physical silver in Shanghai is trading at a massive premium, closer to $67. Global traders see silver for sale in New York at $62 and bid in China at $67. That is a risk-free profit. To capture it, algorithms will flood the COMEX with buy orders the second the bell rings. This arbitrage vacuum is the force that kills manipulation. I expect we gap up, erasing the Friday smash instantly. But I need to warn you, next week will be brutal. Not financially, but emotionally. The banks know they are cornered. Their only weapon left is volatility. They will try to induce motion sickness, spiking the price up and down to make you stress sell. Do not fall for it. Does a $2 price drop change the chemistry of a solid-state battery? No. The fundamentals are inelastic. The price volatility is just noise. This brings us to our final mission. You know the tech. You need the vehicles. We are racing to hit 1,000 subscribers by December 31st. If we hit that number, I will release the killer video, the exclusive list of the top 5 unhedged primary silver miners that I believe will lead this supercycle. I need 1,000 insiders to release the list. The Samsung bomb has detonated. The shockwave hits Monday. Don't be on the wrong side of the physics. Subscribe. Turn on notifications. Class dismissed.